My guest today is Karsten Jeske, who also goes by the nickname Big Ern. Karsten has a PhD in economics and is a chartered financial analyst. He is also an early retiree who fired a couple years ago at age 44. But before that, he taught economics at Emory University. He worked at the Federal Reserve Bank of Atlanta and also at the Bank of New York Mellon in the asset management group in San Francisco. Since early retiring, he's been traveling a lot with his wife and daughter, and he writes extensively on his blog, Early Retirement Now, about financial planning for early retirement, with special emphasis on analyzing safe withdrawal rates in retirement. I invited Karsten today to come and share insights about both safe withdrawal rates and sequence of returns risk, which are perhaps the most foundational financial planning concepts that early retirees must grasp to plan for a successful early retirement, where your retirement portfolio doesn't get depleted to zero before you pass away. So Karsten, thanks so much for joining us today to share your insights and analysis about these important topics.
Thanks. Happy to be here.
I'd love to start out just by learning a little bit more about your background. So you have this really interesting nickname, Big Ern. Where does that come from? Why do they call you Big Ern?
Oh, well, so I started my blog in 2016, and I was still anonymous at that time and early retirement now. So I would sometimes sign emails with Ern as a signature. So the name Ern was already around, and then somebody made it Big Ern. And I mean, if you know the movie Kingpin, right? Woody Harrelson and Billy Murray. Billy Murray is the villain. It's called Big Ern in that movie. I really love that movie. I like Bill Murray, and so the name kind of stuck. And then on top of that, I'm a big guy. I'm 6'6", just under 200 pounds. So that's why it stuck. And I like the name. So yeah.
Awesome. Well, in terms of your background, how did you get into becoming an expert on early retirement finance? And the topics we're going to discuss today, safe withdrawal rates and sequence of returns risk.
Right. So, I mean, I had always planned to retire early, right? Even before this was an issue on the web. And I mean, funny thing is, it was already an issue on the web, and I hadn't just found it yet, right? So I found the whole thing, Mr. Money Mustache and all these guys in 2016, and I started my own blog. But I had already been working on my own plans since I got my first job almost, which was in 2000. And I mean, I realized that you have the challenges of accumulating money, which in some way it's a challenge. It's mostly a psychological challenge almost, right? You just have to stick to the plan and not lose your nerve when the market goes down a little bit. But the funny thing is that the math behind accumulating assets is actually relatively simple, right? There's Mr. Money Mustache has the simple math. It's not just simple math, it's the shockingly simple math of achieving retirement, right? And what I found was, what's not so shockingly simple is then the withdrawal math, right? And what makes accumulation relatively simple is that you have two forces that go in the same direction. You put money into your account, and then on average, at least, you should have positive growth in your account. So they both pull in the same direction. If sometimes you have a little bit of return volatility, returns are low, you put money in, you still put money in, you use dollar cost averaging. And but I realized that on the way out, when you start withdrawing money, then the two forces pull in opposite direction. You hope that your portfolio starts adding some money from capital gains and interest and dividends, and you hope that you don't run out of money before you die. And that is mathematically and financially a much more complicated problem. And I thought, well, before I pull the plug, right? And again, I pulled my plug 20 years early. So I basically made a decision that impacted 20 times annual salaries, right? So you think that buying a house is your biggest financial decision in your life, which is maybe 3x your annual salary. And in the Bay Area, it's more. But for most people, it's somewhere between 2 to 5x your annual income. And that is your most impactful, most extraordinary financial decision you'll ever make in your life. But, well, retirement, now we're talking about 20x, right? So you want to do your math before you make such a wide-ranging decision in every aspect, right? So socially, psychologically, but also financially. And so I thought that, well, there has to be some guidance on the internet. So I started searching and I found some information. I found the Trinity study and Bill Bengen's work. And then also some of the things that the other FIRE blogs were writing about the safe withdrawal math, but it was usually treated as something of an afterthought, right? Okay, well, the biggest challenge is getting there, and then by the way, yeah, once you're retired, yeah, you just wave your hands and you just wing it basically. There's a 4% rule. And off you go. And I thought, whoa, wait a second. It's actually the accumulation part. That was the mathematically easy part. Withdrawing money and ensuring that you don't run out of money, that's the complicated part. And so, I mean, a long story short, it occurred to me that nobody else had done it in a way that I would like it done. So I guess I had to do it myself. So, and that's how I ended up writing a lot on my blog about safe withdrawal math, which, by the way, I write about other topics too, right? It's not the only topic, but it's probably about 50% or so of what I write on the blog is about the safe withdrawal math, and then some other stuff too. But yeah, so that's. But I would definitely say that's a bit of the claim to fame of my blog, right? That I think about safe withdrawal math and safe withdrawal strategies in a way that is scientifically sound and well thought through.
That's really helpful background, and thanks for sharing that. And definitely agree that on your retirement drawdowns during the actual withdrawal phase certainly gets a lot more complicated, and so it makes a lot of sense that you started thinking about this. Before we jump into the details of safe withdrawal rates and sequence of returns risks, just to level set with our listeners. So you've alluded to this already in a few places. So in retirement finance, there's this concept called the 4% rule, which you alluded to. It's a heuristic that was formulated in the 90s by a financial planner named Bill Bengen, which you alluded to, later popularized in an academic paper known as the Trinity study that came out of Trinity University in Texas from a couple of finance professors there. And what the 4% rule essentially says is that on a typical 30-year horizon, if you, as a retiree, withdraw 4% per year from your portfolio, you can essentially safely retire without having to worry about outliving your money. And that works, greater than sort of 95-ish% of the time, historically. So 4% is this heuristic of a safe withdrawal rate. Now, there's been a lot of debate and even updates from the authors themselves to the theory behind the 4% rule in the year since it was first published. And on your blog, you talk in various places about how the 4% rule has a lot of problems. What are the biggest issues with the 4% rule that FIRE adherents should be thinking about?
Right. So, I mean, I actually wrote a blog post on that. The 10 things the makers of the 4% rule don't want you to know. So, which is a non-mathematical summary post. I think it's part 26 of my series. And I think the biggest problem is that you cannot use a one-size-fits-all rule for everybody. I think it's a pretty good guidepost. Say if you are still more than 5 years away from retirement and you want to set something like a target, absolutely do the 25x, right? 25x annual expenses, which is equivalent to the 4% rule. It's a little bit like, say you want to drive from San Francisco to the East Coast, and how do you even start driving? Well, I guess you'll start drive on I-80 to the east. And but then at some point you have to make up your mind where exactly you're going. Are you going to Boston, to New York City, to Washington, D.C., or to Miami? And the closer you get to that target, the more you have to ignore the simple one-size-fits-all rules, and the more you have to start customizing it to your personal situation and then also to market fundamentals. So what I mean by that is that, and by the way, I'm not even trying to ding the researchers in the Trinity study, right? I mean, the Trinity study researchers, they had to make up an academic sample study, and they had to say, okay, we have a retiree has a 30-year horizon, a flat spending profile. I mean, if the Trinity study had started with the retiree, okay, we're going to start publishing a paper, and it's a 37-year horizon, and this retiree has a non-flat spending profile. It's a crazy looking curve. First it goes up and then it goes down and then it levels off and then it goes down more. Then people would have said, well, do all your results come just from using these crazy assumptions? So you had to come up with the most generic assumptions possible, right? 30-year horizon. You look at different asset allocations from 0, 100 to 100, 0. A flat spending profile, but that's not how most people in the real world are going to operate, right? So if you're a traditional retiree, yeah, you could argue that you might have you have, say, you start Social Security and your withdrawal plan at the same time, right? You get $30,000 Social Security, and then you ask yourself, how much do I need to fund the gap between that $30,000 Social Security income and my spending needs? But for example, for early retirees, right? I retired at age 44. So that means I can start drawing on Social Security at age 62. So that's a few years in retirement. Or I could wait ideally until age 70. And then at age 70, I would actually get a pretty meaningful Social Security benefit. And so that means even if my spending profile is flat, it means my withdrawals are no longer flat. I'll start withdrawing more initially, and then I can reduce my withdrawals one for one once Social Security kicks in. I also get a small company pension at age 55. So there's so many idiosyncratic factors in my personal situation that just based off of these idiosyncrasies, some people start retirement at age 30. They'll have to wait until age 70 to draw Social Security. Well, that's so far into retirement that you can almost ignore that as from a computational perspective. But I've done a lot of safe withdrawal rate analysis of people. They retire in their mid-50s and they are getting company pensions and the spouse gets a government pension and they get Social Security. I mean, I told them, you'd be crazy to withdraw 4%. You can withdraw a lot more because you have this two-phase problem where initially you can withdraw probably 7-8%. Then your benefits kick in, and then you can reduce your withdrawals. And then other people, well, if you retire at age 28, you probably don't want to be all the way up at 7 or 8%. You probably don't even want to be at 4%. So there's such a wide range of withdrawal percentages just based off of the idiosyncratic differences in people. And then on top of that, and this is probably something where I would want to ding a little bit, even the Trinity study. Even if we all accept that, okay, yeah, we all start with a 30-year horizon, a flat spending profile, you still have to account for different market valuations, right? So you can't just say every retirement cohort, when they retire, they have the same probability of running out of money. They don't, right? If you had started your retirement in 2000 at the peak of the market, you had very different chances of your retirement going through than somebody who retired, say, in 2003 at the bottom of the market, right? So you have to take into account equity valuations, also in some way bond market valuations, but obviously equity market, that's the portion that has the most volatility. So it's mostly explained by equity valuations. If you are finding yourself after a very long bull market and you retire, then you probably want to have a lower safe withdrawal rate than somebody who retires relatively early in the bull market or even at the bottom of the bear market. So so it's both the idiosyncratic differences across different people, and then also the market valuation aspect across time that should all play into your safe withdrawal math. And ignoring that, ignore it, but you would ignore it at your own risk, right? So so these are some of the things that I'm writing about on my blog. And this is why, again, I said the withdrawal math, that's the complicated part. And that's why I have, I think, 37 or 38 parts in my safe withdrawal rate series already.
Awesome. Well, I definitely want to dive into a lot of the themes that you just identified, including retiring at the top of the bull market versus at the bottom of a bear market, et cetera. One thing I wanted to just pick up on is you mentioned, it's your withdrawal math is a function of your own idiosyncratic circumstances. Do you have a pension? Do you have when can you expect Social Security, et cetera, as well as corporate valuations in the stock market where you're retiring. On the former, some people will get a pension, others will not. But most people, as long as they've worked the requisite number of years, can count on some Social Security benefit. But you mentioned that the younger you are when you retire, the more that you should ignore that benefit. And I was curious, when does that inflection point occur where you should bake it into your safe withdrawal math versus just ignore it, given that Social Security, the base fund, is projected to deplete in something like 2035, and then something has to happen. Either it's just tax revenues that continue to fund Social Security, or everybody gets a haircut, or some other way to raise more money if benefits are not going to take a hit. And since the farther you go out, the harder it is to predict these things. When is that inflection point for you when early retirees should just disregard Social Security, relying on Social Security at all?
Okay, I mean, there's two aspects here, right? So the one is the mathematical aspect of just purely looking at the time value of future benefits, right? So if you're 1 year away from Social Security, well, you have to bridge only 1 year. So the time value of that is pretty much almost 1 for 1, right? And then if you're 40 years down the road, it's almost 0. And in between, it's exactly a sliding scale. So you could say that there's no inflection point where at this horizon you have to ignore it. At this horizon, I'm going to factor it in. No, you should ideally factor it in all the time, and but what you will notice is that Social Security 30 years down the road is probably not going to have such a big impact on your safe withdrawal rate. So say without any benefits, your safe withdrawal rate might be 3.3%, and with Social Security, and you may expect something like a 1 percentage point or 2 percentage point worth of Social Security 30 years down the road, but guess what? That might only be worth 0.1 or 0.2 or 0.3% in your withdrawal. Again, it's not trivial, right? Because we're talking about 0.1% of your nest egg, right? So that might actually so say you have a withdrawal rate of 3.3% and you can raise it to 3.6% in the light of Social Security. Well, that's actually a 10% bump almost in the money that you can withdraw, right? It's only a 0.3 percentage point in terms of your net worth. So I mean, my rule is you factor it in either way. And it's just going to have a very small impact if it's that many decades in the future. Now, the other point is, and I think there is a little bit of a cutoff. So I think the rule of thumb for you is if you look at the political risk, right?
Yeah, that's actually what I referred to.
When will politicians pull the rug under your feet and start telling people, hey, by the way, your Social Security benefits will be lower in the future? And I think the rule of thumb is that if you are 55 years old by the time some transition starts taking place, I think politicians will be very careful about protecting you, because I mean they don't want to tell people. I mean certainly they don't want to tell people at age 65, hey, by the way, we're just going to reduce your benefits next year, right? So that's not going to happen. It's not. I don't think they're going to take away benefits from existing retirees. So basically, what they will do is they will say at some date in the future, if you are 55 and older, you're protected, and if you're under 55, we'll start. And even that has to be on a rolling scale, where you can't tell people, oh, if you were born up to December 31st of this year, nothing happens to you, and then January 1st the next year, you have to take the full force of this reduction in benefits. It will be a sliding scale, right, where they say that for every year you're born after that cutoff date, we're going to delay your full benefits by another month or another 2 months. And then it will be a sliding scale. So, and I think you have to make it to age 55. And in my case, that's going to be 2029. So I hope and I cross my fingers that Nobody is going to dare touch Social Security by then. If you make it to age 55, and if you're not much younger than 55 at that point, it's probably going to be a sliding scale. Because my hope is that politicians are going to kick the can down the road for as long as they can until the problem becomes really, really serious, and then they have to do a reform and recalculate benefits. So that would be my baseline assumption. I think there is a small risk in this would be how they can still hit existing retirees, where they say, well, we're going to change the formula how we adjust benefits every year, right? So there's a cost of living adjustment of the benefits, and there could be some way of messing with that formula where they say, well, guess what? We are no longer going to do it, the full adjustment. We're going to take away 0.1% or 0.2%. And we're going to take a different inflation index to adjust that. So there could be some ways of messing around with that. But again, it's not like when they do that, it would also be a very slowly phased in approach where, well, every year you lose a fraction of a percent of your benefits in real terms. I guess if the problem gets serious enough, that might be in store for us. Yeah.
Okay, cool. Got it. All right, let's shift gears to sequence of returns risk. Before we dive into the details, what is sequence of returns risk?
Right. So sequence of return risk, that is the number one reason why people run out of money in retirement, right? Because if you look at the average retirement horizon is maybe 30 years, and nobody would ever run out of money if your return over that 30-year horizon, which say, for example, over the very long-term equities have returned over 6% in real terms. Bonds, even if right now bonds are yielding maybe only 0 in real terms, you take a 75-25 portfolio, even a 60-40 portfolio, your portfolio return of a diversified portfolio over any 30-year horizon on average should be high enough to sustain a 30-year retirement with capital depletion, that said, right? And so on average, nobody should run out of money if we just had the average return. So the only reason really why people run out of money in retirement is that they had what's called sequence of return risk. That means they had low returns early on, right? And even though you have a pretty decent return over a 30-year horizon, I've done some calculations where over a 30-year horizon, you had a 5% average return in your portfolio, but you still run out of money. How is that possible with a 4% withdrawal rate, right? And it means that early on, your portfolio took such a severe beating, and then you started withdrawing from the portfolio during the trough, during the bear market, and you depleted your portfolio so severely that even the strong rally that followed afterwards, even the strong rally that set the average return over that 30-year horizon to 4% or 5% was not enough to ever rescue your portfolio. And so it basically means that after 2 years, your portfolio is already down by 70%, and you still withdraw 4% from that initial amount, right? So your actual withdrawal rate, your effective withdrawal rate at that time, percent of what you withdraw as a percentage of your portfolio value is much higher than 4%, could be 8%, could be 12%. And even if the market starts rallying after that, it's no longer enough to take you over the finish line. And this is something that it really has to sink in, because we are so used to looking at, say, buy and hold investments, right? So a lot of calculators you see on the internet, you see, well, if you had invested X dollar in the stock market at this year and you let it run for 30 years, how much money would you have, right? And so if you are a buy and hold investor, you don't have to worry about sequence of return risk, right? All that matters is what was the average compound, so the cumulative average compound growth rate over that horizon when you kept the money in. It doesn't matter if you had zero returns for 30 years and then all the returns all the way came only in the last year, or they came only in year 17 and you had zero returns everywhere else. It doesn't matter as long as the total average return was 3% or 4% or 5%. You have the same final value no matter what. But then once you start making withdrawals or you put in contributions, that's when the final outcome changes. It's no longer dependent only on the average return. It also depends on literally this sequence of return. Did you have high returns first and low returns later, or vice versa? Or was it just a flat return, the same return every year, and that would then be the average return, obviously, also over the 30 years. So, and that is basically the biggest headache for retirees, right? It's the sequence of return risk. Are you unlucky and have low returns right early on during your retirement? Or are you lucky and the market rallies, and even if you have a bear market late in your retirement, it's no longer sufficient to wipe out your capital then.
Yeah, and I guess this is what you were alluding to earlier about the danger of retiring at the top of a bull market, and then it drops in the early years of your retirement, and you keep withdrawing, eating into principal during those down years, because then when the good returns finally show up again, it's too late. Portfolio's been ravaged so badly, there's just not enough capital left to restore your savings to outlast you. So I think you called this the poison to your retirement finances on your blog.
Right. Yeah.
Is it fair to say that on average, during your retirement years, on average, each year's portfolio returns are more important to your ultimate retirement outcome than the subsequent year's returns in terms of the predictive power to forecast your ability to outlast your savings?
Right. So basically, what I did, and there are multiple ways of proving that, right? So you look at, so for example, you could calculate your safe withdrawal rate over a 30-year window, or you could calculate what is your internal rate of return for a certain fixed withdrawal rate. So you look at the initial capital value. You take regular withdrawals and you look at the final value, then you calculate an internal rate of return out of that. And you ask yourself, and then you run a regression on that either the internal rate of return or the safe withdrawal rate, and you run a regression as explanatory variables. You use maybe you don't have to use 30 explanatory variables, right? You do it in buckets of 5 years, right? So you say you split the 30-year retirement horizon into 6 5-year windows, and then you run a regression over out of these 5-year windows, which ones are the windows that have the most explanatory power to your retirement success, whatever way you want to evaluate that. And yeah, I mean, sure enough, the first 5-year window has the biggest explanatory power, and then it dies down, and then the last 5 years basically has essentially almost zero explanatory power. And I think I ran a calculation like that in part 15 of my series. I think that's what they're alluding to, and that's exactly the problem with safe withdrawal rates and safe withdrawal calculations. It's the initial returns that pose the biggest risk, and the later returns have less impact. Whereas for a buy and hold investor, right, every 5-year window has exactly the same explanatory power on your internal rate of return. And for the retiree, it's very front loaded. And by the way, for somebody who is the opposite of the retiree, right, you start with $0 and you start making contributions to a retirement portfolio, then it's the other way around, right? Then the later windows, they are the primary source of your of the risk of how much money you're going to have in the end.
Gotcha. So, the Trinity study suggests that if you hit your 25x annual expenses, and you withdraw 4% a year, roughly, you should be fine. Again, kind of more than 95% of the time. But when you factor in all these nuances of, I think in your blog you call that calculation, the Trinity calculation, an unconditional probability of randomly retiring over the last century. Whereas if you retire conditional upon reaching that savings target, but you do it after the long bull market run, it actually be very risky. Not 95% of the time you're successful. It could be much lower. And I was just curious, just so people can really sink this in, that 95% success rate could flip to order of magnitude what? In the extreme cases.
Right. So there are different ways of conditioning it, right? So what the Trinity study does is they would just do the completely unconditional probability. And you could, for example, condition it on, imagine you retire at the peak of a bull market, right? So you look at what is the S&P 500, and is it at the highest point up to that point in history? And yeah, I mean, you could potentially take your failure probability from, say, 4% to 15%, not 50, but 15%, right? You could, instead of looking at relative valuations, right? So this is, I call that relative valuation because relative to the most recent history, we're at the most expensive S&P 500. You could also look at it in terms of earnings, right? So relative to earnings, you look at the price earnings ratio or the Shiller Cape ratio. So same thing. If you condition on the Cape ratio being above 25 or being above 30, yeah, again, your failure probability could go up from, say, 3-4% to 15 to 20%, depending on how you slice and dice the data. And again, and the reason for that is if you look at the historical failures of the 4% rule, they all have one thing in common, right? They happened right around the peak of a long bull market. They happened right at the time when you had very expensive equity valuations. So Cape ratio normally above 20, the really bad ones even above 30, and in 2000, I guess it was even above 40. So these would be the stereotypical cohorts that face a much higher failure probability. So I always use the analogy if you want to calculate the probability of getting into a traffic jam, right? So the way the Trinity study calculates the probability of a traffic jam is that they send 24 people off to drive on, to drive over the Bay Bridge, and they do it at the top of hour, at midnight, at 1 a.m., 2 a.m., 3 a.m., and then people figure out, well, out of the 24, 6 got into a traffic jam, right? 3 somewhere in the morning rush hour and 3 in the afternoon rush hour. So it's only a 25% probability of getting into a traffic jam on the Bay Bridge in San Francisco. And of course, but if you already know in advance, you have to drive every morning at 7 a.m. or 8 a.m. over the Bay Bridge one way, and in the afternoon at 5 p.m. the other way, you will be in a traffic jam 100% of the time. So forget about the Trinity study calculation, 25% probability of a traffic jam. No, your probability is going to be 100% conditional on having these unpleasant and unattractive starting conditions. And this is the same thing with the safe withdrawal math. If you already know that you start at the peak of the bull market, you probably want to be a little bit more conservative, and you don't have that 3% or 4% probability of failure anymore. It might be much higher. I don't think it's going to be 100%, but it will be lower. It will be higher failure probability than what the Trinity study sometimes wants to allude to.
That's a really powerful analogy. I love the traffic jam analogy because it's very internalizable. I'd love to understand, given that no one really can predict when the top or bottom of the market is, but there are indicators. I think you mentioned some statistical indicators like the Cape ratio, et cetera. What to your mind is the most useful indicator to use to assess, relatively speaking, how expensive or cheap we are in the market cycle, and what specific threshold do you, say, personally use as a rule of thumb in evaluating this?
I think the Cape ratio is a pretty good starting point. And what I like about the Cape ratio is that it's accessible, right? You can check it essentially daily. Even if Professor Shiller hadn't updated his Shiller Cape for 2 weeks, all you have to do is look at what he uses as the S&P 500 value. You just compare it to today's S&P 500 value. So you just do the you could use his number. It's probably close enough. If you want to be super precise, you would adjust it from his S&P value to the actual S&P value, and you do a reweighting there.
And just to level set, could you define for the audience?
Right. So the Cape Shiller ratio is it's a price earnings ratio. Right. So you look at how many multiples is the S&P relative to annual earnings. But instead of looking at just 1 year earnings and the most recent year earnings, you look at the 10-year rolling average of inflation-adjusted earnings. And so that makes it a little bit adjusted for that's why it's called CAPE. The C stands for cyclically adjusted price earnings ratio, and
that's to smooth out volatility.
That's to smooth out not the volatility in the stock price, but the volatility in earnings, right? Because we could be at the bottom of a recession and earnings are really low, and you say that, well, you know what? On average, earnings should grow probably roughly in line with GDP. It could be growing maybe a little bit faster than GDP because there's some share buybacks and stuff like that. There's some technicalities, but and then you say, well, if I look over a long enough period, 10 years, I'm going to filter out a lot of the business cycle volatility because the 10 years probably long enough that I filter out the recessions versus expansions. Now, there are obviously some weaknesses of the CAPE ratio because it's backward looking, right? And it's very hard for finance professionals to say, look, I mean, first of all, if I look at only 1 year backwards looking, right, that's problematic because that might be very volatile. So let's look even further back. So you're looking in the rear view mirror and you're trying to drive forward and, well, in order to have more precision driving forward, we not just look in the rearview mirror, we look in the rearview mirror with binoculars or something, right? We're looking really far back, not just 1 year, but 10 years. So I can see that some people would be a little bit troubled by that. And personally, when I used to work in the industry, I mean, we would never look at the CAPE ratio, right? We would look at forward-looking estimates of earnings. Now, problem with forward-looking estimates is, I mean, it seems scientifically more proper to look at forward earnings and not backward-looking earnings. But of course, you also have the estimation error with that. So there's pros and cons for everything. So what I like about the CAPE ratio is that is something that is readily accessible to even laymen. And on top of that, and again, I mean, the main reason is it actually has a very strong correlation with forward-looking earnings. And again, it doesn't have a very strong correlation with tomorrow's stock return or next week or next month or next year even. But if you look over longer horizons, say 5 to 10 years, you start seeing a very strong correlation between the CAPE ratio and forward-looking earnings and forward-looking stock returns. So it is a predictor of future stock returns, and it has to be, right? Because there has to be some sort of a mean reversion of the stock market. If the stock market is really expensive this year, well, it has to adjust over the next 10 years. Now, I can't tell you exactly when and how it will adjust, but in order to get back into some sort of an equilibrium or almost equilibrium, it probably has to return a little bit less than historical averages over the next 10 years. Whereas if stocks are really cheap and we're at the bottom of a bear market, then chances are that, again, we might have gone a little bit overboard with the correction and the bear market, and we could even expect a little bit above average return. So there is some both theoretical and empirical backing to the CAPE ratio. Anyway, so a very long-winded answer. But I mean, if you could definitely do something like you look at the CAPE ratio and tie that to your safe withdrawal math. Now, the problem is the Cape ratio doesn't really move all that much on a day-to-day basis. And I don't think that in the Cape ratio, there's not one fixed threshold where you could say, well, if it's below 20, everything is hunky-dory. And then if it's above 20, hair on fire, panic, run for the hills. It's, again, a sliding scale. And I would, there's some, and again, I don't want to get too far into the details, but I've written on my blog and I've looked at, what happens if you set your initial withdrawal rate as a function of the Cape ratio, right? Now, basically what you want to do is instead of the Cape, you do 1 over the Cape, right? Because the Cape is a price earnings ratio. So it's high when it's expensive and it's low when it's cheap. So you do the inverse. And then you actually get something that is expressed as, say, percentages, right? Then you have an earnings yield, right? So $100 worth of stocks, if the Cape ratio is 25, then $100 worth of stocks would have given you roughly $4 worth of earnings over a 10-year average horizon, right? And it doesn't mean dividends; it's earnings, right? But it's close enough. And so you could argue that your safe withdrawal rate should probably move as a function of the Cape ratio, right? So and I've again, I don't want to get into the weeds here, and there are different formulas and different specifications of how you translate a Cape ratio of, say, 27 into an actual safe withdrawal rate. But I mean, there are some ways of translating the Cape ratio into a withdrawal rate, and that gives you something really powerful. So now you have a valuation-based safe withdrawal rate. And then, by the way, the beauty of that approach is that imagine your portfolio goes down by a certain percentage, right? So what do you do then? Well, then you look again, what is the Cape ratio at the bottom of the bear market? And because the Cape ratio probably went down, right? The stock market dropped. The Cape now looks more attractive, so it's down. That means 1 over the Cape ratio, 1 over the Cape, which is the earnings yield, has gone up. So now you have a higher earnings yield. So it also gives you some sense of, well, if I am in the recession and I'm retired, I retired before the recession, and I'm at the bottom of the recession, at the bottom of the bear market. Now you can actually increase your safe withdrawal rate, but it's the safe withdrawal rate of that diminished portfolio. So there is this effect where you have two effects. Your portfolio is down, but your safe withdrawal rate is up. Right? So they might not perfectly cancel each other out, but it might be a way of having a more flexible withdrawal strategy where you don't insist on a fixed amount of money every month and every year. So you are able to roll with the punches a little bit, right? So you're at the bottom of the recession, you lower your withdrawal amount a little bit because your portfolio is down, but the withdrawal percentage is up. So it's still a net loss for you. You withdraw a little bit less, but then eventually your portfolio is going to recover again. And the beauty of that is again, it's valuation based. And then on top of that, it cushions a little bit your sequence of return risk because you will withdraw less when your portfolio is down. And then you start scaling up your withdrawals again once your portfolio recovers. So it's a very effective and also a robust and it's a concrete way, and it's a systematic way of changing your withdrawal amounts to roll with what financial markets throw at you.
Yeah, that's a really powerful framework. And you mentioned that if you were to use some heuristic like 1 over Cape, you will find that ratio to increase at the bottom of the market, but from a diminished portfolio, and vice versa will decrease at the top of the market, but you have an expanded portfolio. How do you, at least at a high level, if possible, how can an investor who's looking at this situation, trying to determine, how they can monitor and keep on track their portfolio glide path so that they are making wise rebalancing choices and wise drawdown choices, how can they actually take these offsetting effects of portfolio size versus 1 over Cape ratio, sort of offsetting each other, and translate that to an actual number at the end of the day that they have to go tell their stockbroker, hey, this year I want to withdraw X percent? Is there a high level sort of framework or sequence of steps that the layperson, not the PhD economist, but the layperson can grasp to make a reasonably good choice?
Right. I mean, there are different ways. One would be that Cape-based withdrawal, right? So, and I think it's part 18 in my safe withdrawal rate. Yeah, so it's a flexibility and the mechanics of the Cape-based rules, and it's actually not exactly 1-for-1. You don't use exactly 1 over the Cape as your safe withdrawal rate. There's some adjustment factors to that, and I've done some simulations to see how that worked out in the past, and it would have worked actually quite beautifully, say during the 2000 recession, also the 2007 recession. So that would be one thing, right? If you have the flexibility to roll with the punches, and you say, yeah, I mean, I would like to withdraw $70,000 in my first year, but you know what? If the market tanks and next year I have to withdraw only $60,000, yeah, I can sustain that too. That's fine. A different approach would be when you initially do your safe withdrawal analysis. You ask yourself, well, what would have been the worst thing that history would have ever thrown at me in the past, right? And that probably, depending on your personal parameters, it's probably either 1929. Everybody knows that, right? There was a Great Depression, very nasty bear market, very long. Another very bad episode for investors and retirees would have been if you had retired in the mid to late 60s. You had this very mediocre market until the early 70s, and then you had basically one recession, one bad event after the other. So I think in 1970 or 71 you had a recession. Then 73 to 75 there was a recession and bear market. 80 and then 81 to 82 were more recessions and more market drops. And either one of the events was not so bad, but the whole sequence of these events was actually so bad. For some parameterizations, that's actually worse than the Great Depression because it was longer, and so from a sequence of return risk perspective, it was even worse than 1929. So, anyways, long story short, you look at what was the worst thing that history had ever thrown at you, and you set that as your safe withdrawal rate. So now imagine you find yourself in March of 2020, and the market is down by 33%. And you ask yourself, well, do I have to make adjustments now? And do I have to take my diminished portfolio now and apply that historically worst safe withdrawal rate to that newly diminished portfolio again, right? So, or can I keep withdrawing what I initially withdrew? So, and my recommendation was that, well, as long as what happened in 2020 is not worse than what happened in 1929, you should still be safe, right? I mean, from a historical point of view, the 33% drop was not as bad as the 80+% drop between 1929 and 1932. So in that sense, if you had been really cautious and really conservative and say you had retired in December of 2019 after the big run-up, and then 2020 throws a little bit of a curveball and the market sinks by 33%, at that point you can probably say, well, hey, I don't have to do anything yet because this is bad. This is obviously worse than, say, all the corrections we have seen in the 2010s, right, including 2018. We almost had a bear market. There was a drop by about 19% top to bottom in the fourth quarter of 2018. But you could make the case that you don't have to make any adjustments yet, because if you look at what would have been the safe withdrawal rate, say in 1929 or 1930, or whenever the S&P 500 had dropped by 33% during that event, by definition, that initial safe withdrawal rate was still safe, because we just determined that it was safe during the 1929 to 1932 event. And at some point during that event, the market had also dropped by exactly 33%. And in hindsight, that initial safe withdrawal rate that you picked was still safe. So you could make the case that as long as history, as long as the most recent history is still in line with the previously worst events, and it's actually, as bad as 2020 has been so far, it's nowhere close to 1929 and 1930, right? So in that sense, basically what you want to do is you would obviously you would determine your initial withdrawal rate, and then every once in a while you do a check, right? Is this worse than what we have seen in the past? And if it's not, you're probably still going to be safe, right?
When I think about early retirees who are planning essentially 2 back-to-back 30-year retirements, up to 2 back-to-back 30-year retirements, when you analyze these historical scenarios, if we were to take the exact approach that you just said, look at the situations where history threw you the worst, dealt you the worst hand, and if your safe withdrawal rate still works under those scenarios, you're pretty defensible. What is a historically low enough safe withdrawal rate? I'm sure it's lower than 4%, but that would, for all practical purposes, eliminate the sequence of returns risk.
Right. Again, you would probably not eliminate sequence of return risk, but so to answer your main question, I think if you were in the low 3%, I think I once did a calculation. If you had retired in 1929 and you have a 60-year horizon, and by the way, no additional cash flows, right? So you never get any Social Security, any pension, nothing. A little bit over 3%. I forgot whether it was 3.15 or 3.25%. That would have seen you through. So 1929, right? There was another bear market, 1937, right? Through the Second World War. There were a few more recessions afterwards, all the way to 1989. It would have lasted through the crazy 1970s, right? Double-digit inflation, and this was actually, because a lot of people sometimes say that I'm a eternal pessimist and I try to talk people out of early retirement, and I'm way too conservative and way too pessimistic. Actually, that is a very hopeful message, right? Because it means that I had suspected that there are some retirement dates where no safe withdrawal rate would have been safe, right? Where you could have withdrawn zero, or even withdrawing $3 every year would have eventually wiped out your portfolio. No, all you have to do is you lower your withdrawals from 4% to 3%, and you would have been safe even during the historically worst episodes. And unfortunately, so from 1965, we don't have the data all the way to 2025. But remember what I mentioned earlier, right? You look at the time windows. What matters first for your safe withdrawal rates? Well, we have 55 years worth of data, and the last 5 years have very, very little impact on your safe withdrawal rates. So it's actually that 3.1 or 3.2% rate is probably also going to be safe for the 1965 cohort. So it's amazing that you don't even have to reduce your withdrawals by very much. Again, going from 4% to 3%, that is a 25% drop in the amount you withdraw every year. So it is a substantial reduction. But it's not like, you listen to people like Susie Orman. I don't know if you remember that interview where she said, she effectively said, well, if your retirement is twice as long, you need twice as much money, right? And that's obviously not true, because that means she doesn't understand the time value of money, right? Because if you do exactly that thought experiment that you said, that a 60-year horizon, well, that's basically 2 30-year back-to-back windows. And what that tells me is that, well, if I want to have, say, a $40,000 a year retirement, and maybe $1 million is not enough. That is not going to last you through the absolutely worst events. But maybe $1.3 million is all you need, right? You get the first $1 million is going to see you through the first 30 years, and then the other $300,000, you're not going to touch them for 30 years. So that will grow to about $1 million, and that will see you through the next 30 years. And so you don't need twice the money to go through 30 years. So I'm basically in the middle between two groups of people that don't understand amortization, right? Susie Orman says twice the retirement horizon, you need twice the amount of money. No, that's not right. And then, but sometimes in the FIRE communities, you read that, well, 60 years or 30 years, you need the same amount of money, right? Because if you make it through the first 30 years, you'll make it through the second 30 years. But that's not true either, right? Because over the first 30 years, you might make it, but your portfolio is so low at that point that you're not going to make it through the next 30 years. But if I had to pinpoint where I am, I mean, I'm definitely closer to the FIRE community and very far away from Susie Orman, because I'm saying that, well, you have to reduce your withdrawal rate a little bit if you have a longer retirement horizon. But I was amazed by how little you have to reduce your withdrawal rate, and but in hindsight, of course, it makes sense, right? Because it's a little bit like an amortization exercise, and for the years 31 through 60, you don't really need that much extra money to hedge that part of your retirement. And by the way, for most people, it is probably safe to say, if you do this 30 plus 30 year window, think of it as during your first 30 years, you could draw down your portfolio all the way down to 25%, because at that time you will get Social Security, you'll get pensions, probably last 30 years of your life, you might spend a little bit less anyways. So it's not like a 60-year retirement horizon. As a rule of thumb, I always say a 60-year retirement horizon is a little bit like a 30-year retirement horizon, but with a 25% final value target, because for most people, the second half of their retirement, they'll have some other income sources from Social Security and pensions.
You know, there's a heuristic. I think it was first mentioned, or at least I first saw it on Michael Kitcey's website, that if you can just get through the first 10 years of retirement without getting hammered in your portfolio, then your risk of outlasting your portfolio basically goes away. Again, I think that analysis assumed a 30-year retirement. But for early retirees who are planning, again, this idea of two back-to-back 30-year retirements, how should they think about this 10-year heuristic? Should they take it literally, so that no matter how long your retirement horizon is, what matters is literally the first 10 years? Or should they think of it more as a ratio, perhaps, meaning that if your 30-year retirement requires 10 years of non-bad returns, or about a third of the horizon, then a 60-year retirement needs commensurately about a third as well, maybe 20 years of non-bad returns? What's the right way to think about that heuristic?
Yeah, so that's actually one heuristic I don't really like. Again, if you take this literally for the 60-year horizon, then you should say that, well, you have to get through the first 40 years without getting hammered. And then the last 20 years, you basically go on cruise control. And so making it through the first 40 years, that's not going to be a good heuristic for most early retirees. I don't even like that heuristic for traditional retirees either. And the reason is that, well, you solve one problem, you answer one question, but you raise another question that's just as complicated, maybe even more complicated than the initial question, right? Because if it says you have to get through the first 10 years of retirement without getting hammered, well, what is hammered? So imagine you start with $1 million, right? And what is your definition of getting hammered after 10 years? Is that $500,000? Is that $300,000? Is it $800,000? I mean, I can tell you with certainty that if after 10 years you still have $1 million in real terms, so inflation adjusted terms, it's effectively impossible to run out of money the next 20 years. And I did some calculations, and I looked at the question I tried to answer was a different angle, but I just looked at the results this morning, and this was actually something that would answer your question. So I asked myself, I simulated a 4% rule for every starting point over 30 years, and I look at what were the failures after 30 years and what were the successes after 30 years. But I look at not just the final outcome, but I also look at the stages a long time. And I wanted to see, among all the people that failed, what was the maximum portfolio value after 10 years that still made them fail after 30 years. So starting with that $1 million portfolio, I found that there was a cohort that had still $800,000 left after 10 years, and they still managed to fail. And then likewise, what was among all the people that succeeded, what was the minimum portfolio value after 10 years that still made them succeed? And astonishingly, it was $300,000. So there was one cohort, their portfolio dropped in real terms. So not just from bad performance, but also withdrawals. After 10 years, they had diminished their portfolio all the way to $300,000, a little bit over $300,000. And they still managed to succeed in the end. And because I guess it just happened so that 10-year point was exactly the low point of the next bear market. And then you had a very rapid recovery, and they still made it through the next 20 years. So you could then argue that if you look at the spot at 10 years, you have this limbo state between $300,000 and $800,000. So you can say that if you were above $800,000 after 10 years, everybody made it. If you were below $300,000, everybody failed. And then between $300,000 and $800,000, you had that limbo state. And of course, it's also a sliding scale, right? I mean, if you were at $800,000, you still had a pretty overwhelmingly good probability that you'll make it the next 20 years. But at $800,000, this is already where some failure probability creeps in. And at $300,000, pretty much for sure you run out of money, except for maybe one or two crazy lucky cohorts that made it. So again, it's a sliding scale, and then everything in between is in this limbo state. And it's actually I like that question, and it's actually something that I'm going to write a blog post about that. Right? What is the point where you can say I'm out of the woods, right? I don't have to worry about sequence of return risk anymore because the portfolio is so far beyond where it would have ever run out of money historically. Or where's the portfolio what is the point where you can say, okay, now we are down so much, we should really get scared about, should I go back to work again, right? Where is that point? Is that $800,000 is probably a little bit too conservative? Is it $700,000 after 10 years? Is it $600,000 after 10 years? So it's there's no fixed cutoff. It's again the sliding scale. There's no good heuristic, and then on top of that, again, I don't want to fall into the same trap, into the same mistake that I mentioned earlier, right? So imagine after 10 years. You are at $500,000, but you are at the absolute bottom of another bear market. And then you could make the case, well, yeah, I'm down to $500,000, but the next bull market is right around the corner. I would probably still stick it out because, look, this is just temporary and it's going to recover. The market overreacted. Or likewise, you could say that after 10 years, you had a very bad sequence of return event, and after 10 years, you're down to $700,000. But that $700,000, you look at the stock market, has been rallying a lot, it looks expensive again. There's another bear market around the corner, and you're at only $700,000. Maybe that person should worry more about running out of money than the person with $500,000 that after 10 years, but is at the bottom of the bear market. So it's hard to make these sweeping cutoff statements. Well, if you're above a certain amount, you're scot-free. If you're below a certain amount, worry a lot. You can't make these kinds of statements in a completely unconditional way. It again would have to depend also on equity market valuations, right?
Hey, you mentioned in your blog that sequence of returns is a zero-sum game between retirees who draw down their portfolio versus savers who add to it. So, meaning if one side wins, the other loses. Can you explain more about this idea?
Yeah, so I basically made the following thought experiment, right? I looked at 3 investors. One is a buy and hold investor. So put $1 million in, let it sit for 30 years, and then look at what's the final value of that $1 million portfolio after 30 years. The second investor is a retiree. This retiree has also $1 million and then withdraws X amount of money every month. Say, let's make it $40,000 a year or $3,333 a month over the next 30 years. And the third investor is a saver who starts with $0 and puts into his or her retirement portfolio exactly the amount of money that the retiree withdraws. Right. So, and what you can see is that if you add the portfolio values over time of the retiree plus the saver, that it has to exactly equal the buy and hold investor, right? Not just at the final point, but even over time. And so I made the point once that so sequence of return risk is in some way is a zero-sum game, right? So if the retiree manages to get lucky and get an internal rate of return of the portfolio over the 30 years that is higher than the buy and hold investor, then the saver has to have a lower IRR, internal rate of return, than the buy and hold investor, right? Because they are on opposite sides. If one does better than the buy and hold investor, the other one has to do worse. So I try to make this point that savers and retirees are on the opposite side of this sequence of return risk. So it's in one way, it is a cute mathematical observation. In another way, it's actually a policy recommendation in this, right? It means that if people could pool their risk, right, and you pool together not retirees all of the same age group, but what you want to do is you want to pool together retirees of different ages over time, there could be some pooling of risk. And so, I mean, in some way, from a policy perspective, this is actually a rationale to have company pensions, right? I mean, I think company pensions, they have all sorts of problems, right? In the sense that, well, what if the company goes bankrupt, and what if they mismanage their pension fund, right? What if they do all sorts of crazy stuff with that pension fund where there's some backdoor deals going on with money managers doing some crooked deals with the pension funds. Look, if you like movies, the movie Casino, right, with Robert De Niro, what pension funds and unions and pension funds can do to mismanage money. But anyways. Taking that all out and looking at just the policy perspective of that, so there is a rationale for people to pool their risk, and I don't know if a pension fund is the ideal way of doing that, because there are some principal agent problems, right? The people that manage the fund, they might not make the right decisions because it's not their money that's invested, but. There would be some way of, I mean, maybe we should have some kind of a fire pension fund, where there are still people that are saving for FIRE, and there are other people that are already in FIRE. And because your sequence of return risk are exactly flip sides of each other, there would be a way. We should have some kind of a FIRE pension fund that shares the risk, that pools the risk of the people that are already retired, that have sequence of return risk, versus the people that are still starting out in their FIRE path. And if they have a recession very early on in their FIRE path, while saving for retirement, it could actually be good for them, right? Because they do the dollar cost averaging. So there could be a way for us to pool that sequence of return risk. And I found that really intriguing. I never wrote more about this idea, but I thought there was an intriguing finding that we're on the opposite sides of sequence risk, and that we should maybe find a way to pool that risk. Different people in different stages of FIRE.
Yeah, that's a really interesting idea. I guess it would also require a covenant by everybody participating to still play by the rules through thick and thin. Because if anybody breaks, there's a little bit of game theory here. If anybody breaks, then that hedge doesn't quite work out.
I mean, it can't just rely on voluntary contribution, because everybody will say, well, I no longer want to be part of this because I realize if I drop out, I get more money. So this would have to be, again, it has to be a pension fund, or if people pool their money, there would have to be some paperwork signed to make sure that people don't shirk on this. Yeah.
Hey, Karsten, so I realize we're way over time, but this is such a fascinating conversation and so rich. And there's a few questions more I'd love to ask. I'm definitely going to break this up into a couple of episodes. That occurred to me about midway through. But mostly I want to be respectful of your time. If you have to run, I totally understand and we can wrap. But if you're good, I would love to keep plowing through a few more.
Oh yeah. I probably have time until noon. So yeah.
Okay, great. That definitely should be enough, I think.
Yeah.
Okay, cool. Then moving right along, you've previously written about real estate and its interaction with safe withdrawal rates. How can early retirees use rental real estate to reduce sequence of returns risk and just control their own retirement outcome a little bit better?
Yeah, so again, there are a lot of people in the FIRE community that achieved FIRE through real estate investments. And by the way, if you have only real estate investments and you don't even have any paper assets, you don't have a 401k, you don't have a stock portfolio, I mean, you can look at your cash flow and you say, look, I mean, I have $1 million worth of rental of rentals, and I generate, after all costs, right, after allowing for vacancies and delinquencies and property taxes and insurance, and I generate $40,000 worth of rental income. You could even argue that, look, I mean, that rental income will go up with inflation every year, so it's almost perfectly hedges your inflation risk in retirement. So the point can be made that real estate is actually a really great way to live in early retirement without sequence of return risk, right? Because you don't have these paper assets that sometimes on the way down, they overreact and you have to sell your assets, your paper assets at very depressed prices. Now, we will see how all the landlords will make it through the 2020 recession, right? Because you hear already that there's delinquencies of rentals are up. There's some people calling for a rental strike, which means that not just the people that are cash flow restricted to pay the rent stop paying the rent, but even people who have the money, they just say, hey, I'm just going to stick it to my landlord right now. So how is that going to all work out? So I think that rental real estate is actually a very viable and very valid approach to early retirement. It has a few headaches, right? Because what if you have $1 million worth of rental real estate equity, but it's actually $5 million worth of properties and $4 million worth of mortgage. And until the mortgages are paid off, your rental properties are actually not really cash flowing very much, right? So you have this very lopsided cash flow over time, where initially, when you still have the mortgage, there's not a lot of cash flow that you can use for your own consumption. But then when the mortgages are paid off, boom, your cash flow goes up to probably more money than you can ever spend in retirement. So how do you equalize these cash flows? I guess you could draw on some lines of credit. So anyways, I don't think that my blog is particularly useful for the people that have only real estate and nothing else. But I definitely realize that there will be a lot of people that have, say, 70% of their portfolio is in paper assets, and then they have some real estate on the side too. How do they factor that in, right? And so here again, I think there's a real need for a very careful safe withdrawal analysis, right? Because you could be one of these landlords, you still have a mortgage on your property, and your rental property is not really paying you a lot of cash flow right now. But then once the mortgage is paid off, then boom, you go from roughly breaking even to making a ton of money from your rental because your rental is paid off. How do you factor that into your withdrawal rate? I mean, the Trinity study doesn't give you any guidance on that, right? But so it again looks a little bit like this pension or social security consideration, right? You have to front load your withdrawals a little bit from your paper asset portfolio. So you withdraw more from your paper asset portfolio initially while you still have the mortgage. And then once the mortgage is paid off, now you have better cash flow from your rentals. Now you can reduce your withdrawals from your paper portfolio. What kind of an impact does that have in your overall safe withdrawal rate analysis? And so again, I have a toolkit where you can run your own safe withdrawal rate analysis, and you can basically put in these supplemental cash flows. So you can have a mortgage, you can have Social Security at a future point, you can have your rental income. The rental income, the cash flow could be really low initially, it could be negative initially, potentially, right? And then just at a future point, the mortgage is paid off, and then you have a nice cash flowing property. So all of these things, they again, this shows you that you have this great need to do your safe withdrawal rate analysis on a personalized basis. You can't just take an off the shelf safe withdrawal rate. It's, as I once made that analogy, is like requiring everybody to wear 10 size shoes, right? And they'll be too tight for some people and too loose for other people. It might be a good starting point, but it will invariably, it will be the 4% rule will be too tight or too loose for other people. And so again, yeah, I like the idea of rental real estate as a hedge. I mean, first of all, as a diversification, obviously, right? So you don't have all of your eggs in one basket. It's not all in paper assets. It's not all in equities. And so I personally invest in rental real estate, not my own rental real estate, but it's through some private equity funds. And I mean, we're so far very happy with the returns, and it's a diversification. There's some cash flow benefits from that. And again, I mean, of course you could always argue, well, rental real estate, you could have lost a lot of money in 2008 and 9. But I mean, the people that did this properly and they knew what they were doing and they would not go into too much leverage, the people that didn't buy at the top and they didn't have to sell at the bottom at fire sale prices because they didn't get the financing or they couldn't they couldn't refinance their mortgage. Most people that do real estate, I mean, they have been around for many years and decades, and they made it through 2008 and 9. And so, for example, the private equity funds that we use for our real estate investments, they all did very well during 2008 and 9. So, for example, multifamily rental real estate did relatively well in 2008 and 9 because everybody who lost their house, they had to move somewhere. They had to move to apartment buildings, right? And so we will see how it goes this year. I've already gotten some notices that the delinquencies are up, but a lot of people, I mean, they're working with management. They say, look, it's just a cash flow problem. I'm waiting for my unemployment benefits to come through. And as the tenants, they want to pay. Definitely. I think that what people have to keep in mind is that even though rental real estate is not 100% correlated with the stock market. I mean, it is definitely correlated with the economy, right? You will have more delinquencies. You will have potentially more vacancies if the economy is in a recession. So don't consider rental real estate as some 100% safe asset either, right? So you have to keep in mind that there's still some volatility there.
Although I like the comparison to supplemental cash flows like Social Security, except that in rental, where the bulk of your cash flow comes right after the mortgage gets paid off, similar to how Social Security gets paid out when you hit a certain age, except that in rental real estate, there's perhaps even less political risk, right? Because you can guarantee that once the mortgage is paid off, people still need a place to live, and as long as you bought in a geographic area that doesn't totally go down the drain, that has some staying power because there are good jobs and strong local economy, then you'll probably be able to secure good renters, even after your mortgage is paid off. So I like that comparison a lot. Yep. In one of your posts, you mentioned that the return profile that you exactly want to avoid is high returns during the early accumulation years, followed by low or even negative returns in your late accumulation years. And then in retirement, it's the opposite. This is the sequence of returns risk thing that we were talking about, earlier, is that you want to avoid low returns early in retirement that are then followed by high returns in your late retirement years. So they're sort of mirror images of each other. And is it, is the right way to think about that sort of in the same vein as that zero sum intuition, that because when you're adding, your portfolio gets amplified in exactly the opposite way that somebody who's drawing the portfolio down? Is that the right way to think about that?
Right. So, for example, if you had started saving for FIRE right around, say, 2009 at the bottom of the stock market, I think from March 8, 2009 to March 8, 2010, you had a 1 year rolling window where the S&P, I think, returned about 70%. It's not a calendar year return. I think the highest calendar year returns were around 30% in 2013 and 19. But there was one rolling 365-day window where you had a 70% return. I mean, if you had just started out at that time, well, the 70% didn't really make you a lot of money, right? Because you invested $1,000 a month, and of course, the first $1,000 that made you $700 return, but it didn't. So you would have been better off if the 70% return happened right at the end of your accumulation phase. So as I said, there's that flip side between retirees and people saving for retirement. And again, I'm not saying that if you start saving for retirement and during your first year you make 70%, I'm not saying that's bad, right? I'm just saying that could have waited a little bit longer until I've actually gotten my first $100,000 and then I get the 70% return. But I'm not saying it's bad. I'm just saying that it could have been even better if that big growth in equity prices had happened a little bit later. So I don't. For example, I just want to give you two other anecdotes. I got my first job in 2000, right at out of grad school, right at the peak of that stock market, and then I moved from the Federal Reserve to the private sector in 2008. Right around it wasn't quite the peak, but it was still close enough to the peak. And then you had the next bear market coming. And so I was really lucky that I had very bad returns during these 2 points where I first started making contributions to my savings, so in 2000, and then in 2008, where I started making even larger contributions to my savings because I moved from the government sector to the private sector and I had more money to spend and more money to save. And so I was one of the winners of sequence of return risk because I started right around the time when the markets completely tanked, and I lost a little bit of money in the beginning. And but then mathematically that was good for me. Actually, potentially psychologically, it might not be good for you because I'm pretty sure there are tons of people who got so psychologically scarred from either the 2000 to 2002 or 2003 bear market and the 2007 to 2009 bear market. They said, well, I sold all my stocks. I'll never touch stocks again. I mean, I was always the other way around. I said, okay, if stocks are on sale, yeah, I'm just going to keep buying and it will come back again. So again, from a mathematical point of view, you are better off as a saver if initially you have low returns and then it snaps back when you already have a little bit of nest egg on your side.
So you kind of write about how the ideal allocation then is holding as much equity as possible during the early accumulation years, and then transitioning in the later accumulation years to a greater share of fixed income, and then doing exactly the opposite in retirement, starting with more fixed income early in retirement, then transitioning to a greater share of equity in the outer retirement years. So if the ideal return profile is, if you had to sequence the returns in an ideal way, is low returns early in accumulation, high returns late in accumulation, and then the inverse in retirement. But you have a large share of your holdings in fixed income precisely when the market is rallying. Then how I understand the hedge principle of not being so exposed to equity, but that also means that you don't capture in the upside, right, during those rallies?
Oh yeah, I mean, so again, it's purely a hedge. It's an insurance where you say that, look, if I start retirement and I have something like, maybe you want to go not far below a 60-40 portfolio and somewhere between 60-40 and 75-25. So 60-40 means 60% stocks, 40%, what I use in my simulations is 40% 10-year U.S. Treasuries. And then maybe on the upside, you can go to 75-25. And again, it's purely a hedge, right? If you're lucky and the stock market keeps rallying right around your retirement date, yeah, you gain a little bit less. And so, you could have made the case, hey, just should have stayed 100% equities and you would have made even more money. Which means that, well, in retirement, you probably would have made so much money that you're going to end up with millions and millions of dollars when you die, which is a nice thing. But again, it's purely a hedge because if it goes against you, then you definitely don't want to be 100% equities throughout your entire life. Because at 100% equities, definitely the safe withdrawal rates would be, I think they would be even below 3%. They would be probably closer to 2% than 3% if you do the 100% equity approach. Now, of course, it could also go wildly in your favor, right? Where you could say, then it's your choice. Do you want to still withdraw the same? If it goes in your favor and the market keeps rallying and you had 100% equities, forget about 4%, right? Then you can probably withdraw the 5, 6, 7, 8%, or you keep withdrawing your 4% and then you'll have tens of millions of dollars left over after 60 years. But again, that's not really the issue here, right? The issue is, do you want to hedge the downside? And hedging the downside, it's definitely better to have some diversifying assets right around the time you retire. And then the question is, if the market tanks, then you could argue that, you move into equities over time. So you use something called a glide path back into equities to capture the the rally that will obviously come eventually, right? If you every bottom of the bear market so far has seen a nice strong recovery again. Or you could actually say that you keep that 60-40 or 75-25 forever. It's just for peace of mind. And if it goes well, you might as well keep the 75-25. So you do this glide path back into equities only if you find yourself in a big bear market where you would effectively then you would withdraw money out of your fixed income portfolio and you would keep the equities untouched. And you can do that for a number of years until you run out of money in your fixed income portfolio. And then you never touched your equity portfolio. And then that will eventually recover, obviously.
Earlier when you said something around a 3.15 to 3.25 withdrawal rate is low enough to virtually, if not eliminate sequence of returns, at least make it more or less irrelevant. Roughly speaking, what type of split between stocks and bonds was that assuming?
I think for that, I assumed a 60-40. And again, I don't want to sound like that this will eliminate sequence of returns because, again, if you pick a safe withdrawal rate of, say, 3.2%, you still face sequence of return risk in the sense that if the market just turns out really horribly, you don't run out of money. But if the market is actually really strong early on in your retirement, then you can say, hey, I mean, that initial withdrawal rate that I picked, that was way too low. I can now walk up my withdrawal amounts, right? It's not like, so if you do these fail-safe calculations, right? So in the worst possible case, you just make it. And in the not so worst case, it just means that, well, either you have a ton of money left over when you die, or you could actually walk up your withdrawals and give money to charity, give money to kids. You might be so rich, right? I mean, they might name buildings after you at the university, right? I mean, I'm not saying that you can eliminate sequence of. You still have the sequence of return risk. Only it's between making it and making it really, really nicely. So that and then the other thing I wanted to say is that, of course, this relies on historical simulations, right? So you still have a failure probability, and the failure probability is that, well, you would fail if the future is significantly worse than what we've had in the past, right? So it doesn't mean that that's 100% safe withdrawal rate. I mean, some people might say, well, you can never even be 80% sure that the future is going to be as good or slightly better than the past. There could also be a possibility that the future might be significantly worse than the past. And we don't really know what kind of probability to assign to that. So when I talk about failure rates versus success rates and failure probabilities and success probabilities, sometimes I mix them up, right? But so what I really mean, these were the rates in historical simulations. Does that really translate one for one into probabilities? I mean, it depends on your assumptions, right? Is the future going to be worse or not worse than what we've seen in the past?
For folks thinking about FIRE right now, how has the way we should analyze our early retirement prospects changed in recent months? Coronavirus has exploded. When we compare pre-coronavirus stock market highs where valuations were really very expensive versus now, the economic damage and stock market corrections that have happened, how should we be adjusting, if at all, our assessment of early retirement prospects now compared to previously?
Well, I mean, first of all, it's astonishing that the market isn't even down so much, right? So we're recording this on, May 17th. So, we have recovered quite nicely from the low point on March 23rd. And it's astonishing how in light of all of this macroeconomic uncertainty, the market hasn't dropped by more, right? Because you could say that the drop in economic activity is for sure worse than we saw during the Great Recession. right? It's probably not quite there at the level of the Great Depression. The pace is definitely really bad, but at least there is this prospect that, once states start reopening and people realize that, everybody just wear a mask or go out, and it's one of these 20-80-20 Pareto principle things. Maybe the lockdown helped a little bit with keeping people out of the hospitals. And if we discontinue the lockdown, but we're just careful about what we do, maybe that's all we needed in the first place. And if that's the case, then, definitely the economy is going to jump back relatively quickly, right? So in that best possible outcome, you could argue that maybe this is a recession extremely deep, but it lasted only really 2 months, right? The recession might already be over. So in terms of growth, May is already slightly better than April, and a lot of people make this straw man argument where they say, well, the economy is not going to jump back to where we were in January over the next 2 months, and they say, so this has to be really bad. And it might be bad, but and the recovery is definitely going to take longer than the 2 months that it took on the way down. But at least there are signs of some growth out there. There might be some states are reopening now in May. The more states will reopen in June. And I liken this to, so we are going from being hit with a 2x4 over the head to being hit with only a 2x2. So it's still awful, but even something slightly less awful than March and April is already growth, right? So you might have probably the shortest recession on record, and so then recovery after that. But again, I will definitely, if I were to retire right now, I would be very cautious with my safe withdrawal rate, right? Because it seems quite unusual that the market hasn't dropped by much, and then I think the market is it's still quite expensive, right? We went from a Cape ratio of over 30, it's still at I think about 27 or so, and that's still very expensive in historical comparison. So the market hasn't really gone down by enough to say that, everything is good again in terms of valuations. It's still quite overvalued. And there is obviously the risk that if this rosy assumption that I told you about, again, my assumption is not as rosy as, well, the economy went in the tank for 2 months, and then in the next 2 months we're going to dig out of this and everything is going to be bad. No, I'm not saying that, right? I'm actually saying something like the economy went down for 2 months, and it's probably going to take about 2 years until we even reach the old high, right? But, well, it just means that we lost about 2 years worth of growth, and then we keep going from there. That's actually not so bad. I mean, that would justify roughly losing 2 years worth of growth in the stock market. Yeah, I mean, that's about a drop of 15% in stocks, which is roughly where we are. And so in that sense, in that best possible scenario that I described, where we start digging ourselves out of this mess over the next 2 years, in that best possible scenario, I think that the stock market is actually justified to be where it is right now. But yeah, there's some downside risks, right? I mean, what if some other critter comes back next year that's more virulent and more deadly? We're going to have the same mess again next year. Are we going to have a shutdown now every year during February, March, April, May season? I mean, that would be really bad for the economy. It would be very bad for the stock market. If that's, go ahead.
Well, what is your own asset allocation right now, given the current environment? How do you expect it might change or not as you look into the future, given everything that's happening?
Right. So my asset allocation is, so we have about 50% equity index funds. I do 36% is is my option trading strategy. So that might be a topic at some other time. So I do an option trading strategy. I sell put options on the S&P 500 index. Do that 3 times a week: Monday, Wednesday, Friday. And it's not day trading. It takes me anywhere between a few minutes to maybe half an hour, 3 times a week to do that. I sometimes do that on the ski lift on my Android phone. It's not much to it, but it has been very profitable, and it's also relatively stable income. So that's why I like that. So there's 36% doing that. And then we have 11% real estate. So I mentioned that briefly earlier. That's the private equity real estate funds. And then we have about 3% is cash. So very short-term, risk-free instruments, money market, CDs, or simply just cash sitting in the account, which is, the interest rates are so low now, so it's not making a big difference. And so that hasn't really changed much. I'm always looking out for some real estate opportunities. Again, not for me personally to become a landlord. I don't want to deal with the management of this. But I'm definitely looking for opportunities to raise that real estate portion. And so we're working with 2 different providers, actually from the Bay Area. It doesn't mean that the real estate is all invested in California. There's a lot of properties in California, but also other states, all the way to Virginia, Utah, Washington, Arizona, Texas. And so I like the diversification there, and I like it that they manage it, and I don't have to get my hands dirty. And I could definitely see myself increasing that maybe to 20%, and I take a little bit of money out of the option trading over time.
Well, Carsten, this has been a really delightful conversation. I've had so much fun. It's really, good analysis and just understanding sort of how you think about this from an economist point of view. Where can people find out more about you and your work?
Oh, yeah. So I'm at earlyretirementnow.com. It's all one long word, earlyretirementnow.com. And I'm on Twitter too, but you can find everything on the blog. So the contact information, my Twitter handle. And there's also, if you want to see the parts of the Safe Withdrawal Rate series, there's at the top of my site, there's the main menu. So click on the Safe Withdrawal Rate series. So that's a landing page where I have a quick description of all the different posts that I wrote so far and what to read first, because you don't want to read it all in the sequence that I wrote it, because these are just my crazy ideas over the last 3.5 years. You probably don't want to read it in the same order that I wrote it. And so there's some guidance on who should read what and when. But there's also the list of all the 37 or 38 posts that I have so far.
You could turn that into a book for sure. But we'll link to the series in our show notes so folks can have easy access to it. Carsten, thanks so much for taking the time to chat with me today. I know we went way over, but really valuable content, I think, for our audience, and look forward to sharing it with them. Thank you so much.
You bet.
Cheers. Take care.